Good morning and welcome to our webinar, The Case for EM Bonds, High Yields, Better Value. Over the past couple of decades, the EM markets debt segment has matured meaningfully with deeper local markets, a more robust corporate universe, and a more diversified investor base. Today, these same emerging markets have been among the best performing categories in fixed income this year, surpassing segments like US high yield, broad US, and the global ag. So what's driving this performance? One of the main factors is higher yields than those in developed markets. EM bonds offer some of the highest yields in the fixed income space, and this income portion of their return has been crucial in the past few years. And this is coupled with better fundamentals in many emerging nations that display strong fiscal and monetary discipline and lower debt than developed markets overall. I am David Barros, Associate Product Manager at VanEck, and I am happy to be joined by Eric Fine, the Head of Active Emerging Markets Fixed Income and Portfolio Manager of the VanEck Emerging Markets Bond ETF, and Bill Sokol, the Director of Product Manager at VanEck. Today, we'll take a closer look at the performance drivers for EM debt over the past decade and how they've evolved over the years. We'll also compare those to developed markets and explain how EM shines in comparison. And finally, we'll look at how the VanEck Emerging Markets Bond ETF utilizes an active blended approach to harness the most compelling opportunities in EM debt. So with that, I'll hand it over to Eric so he can take us through the case for EM bonds. I think you're on mute, Eric.
Thanks, Dave. Thank you, everyone. Yeah, I'm going to summarize the case for EM bonds. We've been writing versions of this that have evolved, but we've always made the same point, and the performance of EM versus DM has always been there. So yeah, let's just get into the thesis that continues. These are observations at this stage. These are observations using an ongoing framework that we've used for over 10 years, and it's continuing to play out. That's maybe another way of describing it. You just might not have noticed it because EM bonds isn't one of the major categories of bonds that U.S. investors think about. So what's the case? Fairly straightforward and topical. So it starts with debt levels. This is general government debt levels of the developed markets and the EMs broken down by region. And you see a basic difference in starting point. The DMs have very high levels of government debt. The EMs have much lower, very stable, and Asia the best of the best. And fiscal dominance, which is a word you might have heard a lot lately, and something we've been using for over 10 years, and we've been framing the world through the lens of fiscal dominance. Fiscal dominance says that when government debt is above a certain level, monetary policy gets co-opted. So let's see if that's been happening, right? So these highly indebted countries, the DMs, have been maintaining very low real policy rates. Their central banks, this is the history of the DMs' real policy rate, and very, very low, and seems to, during risk-offs, focus on financial assets on the portfolio balance channel, which is obviously not something that the EMs do. And the EMs have maintained consistently high real rates. Their central banks consistently high real rates, exactly what fiscal dominance would tell you. That's why we thought it was so important to write about even 10 years ago. It should have meaning. Despite this blob of EM being higher in real terms, but it doesn't look that, it looks great actually. But when you break it down to the country by country level, you get even greater divergences. You can find even bigger winners. This is one of the reasons why it's probably right. Most institutional investors think you have active management in this space. You want to find the high yielders, and you want to avoid high yielders where maybe the yield should be higher, right? But this tells you that there's a lot of variety inside EM. It's not just this blob that I showed you on the line before. And the real winner has been Asia. The real winner from this initial condition of Asia in particular having the lowest debt. I don't break it out by region here, but their central banks have maintained high real rates for longer. And They have been the big winner, right? They can borrow at much lower rates. Um, and for 6 years, their rates have been rallying. This is an observation of a thesis unfolding. All this is local currency yields in EM broken out by region. This is Latin America, this is CEMEA, and this is Asia and Asia X. And we minus the US yield just to normalize it. And so what you see is for 6 years now, Asian yields have collapsed to US yields. This is a triumph of the absence of fiscal dominance, right? Had the lowest debt, the most established trade records. And the idea is that should spread, right? This has always been the thesis that LATAM has countries with those characteristics. CEMEA does as well. Um, and this is what's happening in local currency so far using the fiscal dominance lens. Low debt should mean an independent central bank, which should mean your local currency yields got lower. Well, what does it mean for dollar bonds? That's an easier story. We emphasized this 10 years ago when we started using this framing. It's a much easier story because if you owe and I'll just tell you the punchline, this is EM sovereign spreads over time, so very high and volatile, and now much lower and in a range. We put on top the growth in reserves in EM, because this is owed in dollars. If you own a bond and if you owe in dollars, it's fairly easy to compare what you owe in dollars and what you own in dollars. And that's why these spreads just had to collapse. And that's somewhat of an old story. It's still ongoing. We still see great opportunities in that space. But this happened first, and this happened next, Asia being the first here in local currency. So that's the fiscal dominance story and what it's been doing to local currency bonds and dollar-denominated bonds. And here's a more precise measure of by how much borrowing costs or the premium versus treasuries in local currency has been falling over the last 17 years. We use different time horizons, of course, because not all of these indices have existed for the same 30-year period or whatever. So this is a real thing. These yields are declining, and it makes sense, and we think the proper framing is fiscal dominance. And here's the narrative version. But the story here, this is sort of a newspaper version of the story, or no, it isn't the newspaper version, but you've heard, reading newspapers the last 25 years, what's happened, and this is a fiscal dominance framing for this. So the dark blue is the EMs, and it's their current account deficits or surpluses. And in the old days, 80s and 90s, they ran big current account deficits, which economists think of as dissaving, which is fair. You can look at the literature, won't get into that, but big dissaving. And what happened, every crisis in the world was an EM crisis, and deservedly so, right? But then something happened. They ran nothing but these mercantilist surpluses for decades. That's what politics is addressing right now, is these massive surpluses by EMs, particularly in Asia. But notice no crises in EM, right? Russia crisis was sanctions, not that was a little unique. But who's running the deficits now? The DMs, massive dissaving, right? You hear about the fiscal side of it. Economists prefer to look at it a little differently, but fine, fiscal is a big part of it. And what has been the result? The U.S. global financial crisis, in which and we guaranteed all global banks in that crisis. Eurozone crisis, the ECB essentially guaranteed sovereign spreads or started targeting sovereign spreads in this crisis. What did the EMs do to solve their crisis? They let insolvent financial institutions go under. They did not tie the sovereign to a bank or a financial system. They sold valuable assets like Daewoo, the exact opposite of these policies. And what's the result? Every crisis in the world is a developed market crisis. And like I said, we're going to add longest government closure in U.S. history here. But this is a real thing. This is a real way to understand the world, and it's based in economics. Just saving or saving, it's been happening for forever. And again, it reminds you that we're making observations from the results of decades of things that have been happening in EM. I know a lot of folks this year, the dollar debasement trade has been popular, and that's kind of the gateway into some of these discussions. But this is an old thing, and this is another trigger for the discussion: is that central banks are holding less treasuries and dollar and treasuries as a reserve asset. That's getting attention. They obviously purchased gold. And as we know, we're longtime sell-side economists. We never really trusted the gold statistics. But I think that was sort of an almost adorable feature of markets, is that there was this kind of expectation that the central banks were going to send a press release about their intentions on their asset purchases, which is, like I said, uh, uh, kind of a adorable assumption on the market. And the same thing on FX discussions. So central banks reduced their purchases of treasuries. They bought gold, and what else are they buying? They're buying our bonds. They're buying our bonds. That is part of this story, right? The creation of the BRICS. When you saw these stories in the last 5 years about India, China, UAE, Brazil agreeing to trade in each other's currencies, that is the starting point. No central bank or sovereign wants a pile of currency. They open a line with with the central bank to own bonds. And they, like with gold, there should not be this sort of adorable assumption that they're going to send a press release. You got to surmise this stuff. And I think that's a big thing the markets have kind of missed this year. But again, a reminder, this is old news to a big extent. You may be in the audience newly paying attention to it, but it's not like it all of a sudden got good this year. And the big rubber hits the road moment is CNY. CNY, the Chinese currency, has been incredibly stable. This is the more new thing. This is the why you need to pay attention even more now. Now, what's the idea on CNY? First, it's very cheap, about 15% undervalued according to the Bank for International Settlements. And that's because it's had very low inflation relative to the US. That's all, right? Not invoking anything else other than inflation. It's had low inflation, US has had higher. And that's accumulated into 15% undervaluation for CNY. So it's a cheap currency. EM and US inflation has been trending largely upward, and EMX Asia has been trending downward. So you already have lower inflation and higher nominal and real yields in most cases. And remember when I told you the story about how these countries dissave the developed markets, well, the developed markets here dissave? So you might have heard the twin deficit concept, that if you need to that if you can borrow only domestically, it's very different than if you need to borrow offshore as well. And if you're running these big deficits, you need to borrow offshore. Why does that matter? Well, rather than tell you why, I'll just show you an example. Um, uh, if if you need to borrow offshore, let's look at a country like Japan. Japanese investors typically hedge their U.S. Treasury purchase, right? If you read the Wall Street Journal, you read once a week how Japan and China have about $1 trillion in treasuries. Well, they typically hedge that and into yen, of course. When a Japanese investor hedges a treasury into yen, they end up getting about 1/4 the yield of an unhedged JGB, their own government's treasury bond. So why would they do that? They wouldn't, right? It's been the FX hedging has been a big part of the story. So how might you measure what this dependence that I talked about here, this dependence on external financing, could mean? Well, this is a simple model, and it says using NIIP as a percentage GDP to explain government bond yields, and we got a very high R squared, yields should be much higher, or the dollar should be a lot weaker. But a fun model, if there are any bond geeks, we don't see this sort of framework being used much, so we think, but it's another way of explaining what's going on. Now, here's the real why not for this year. Remember the beginning of this year, what did all the cool kids say during the tariff and Trump uncertainty? They said that EM was going to get destroyed and their currencies were going to weaken. The exact opposite happened to all categories of EM bonds, whether it's corporates in dollars, sovereigns in dollars, or local currency. And why was that? We think it's very, very simple, that these countries have big surpluses. We don't show the chart, well, we show the charts later. These countries are sitting on large stocks of these accumulated surpluses. So they've got high NIIP or high net creditor status, more dollars. They own more of us than we of them. And then they have a trade negotiation. You're China, you have your trade negotiation, and your starting point is you're up to your necks in dollars. And what did you learn in the negotiation? You learned that the dollar needs to go down against your currency. Again, if you want to have the sort of, I think, adorable assumption that the central banks are going to send a press release, that's we don't think the world works that way. So you're long dollars and you're being told dollars got to go down in the tariff discussion. That was the entire point in many ways of the tariff discussion. And that's why this happened. That's why this happened. First time it didn't happen. And this was completely unpredicted by markets. So it's another reminder that we're in, that there's a really strong why not or why now. And here's kind of the cherry on top. We know that the yield is higher in EM, whether it's local or hard, than DM bonds. We know when you look back 20 plus years, the vol adjusted return has been superior. But interestingly, the overall EM local currency bond market now has lower volatility. So I guess, if you got higher return and lower vol, I don't really know what more argument there is in finance. It's nice to have fundamental backing for it and a consistent story and framework behind it. But I think that's kind of a punchline, is this right here. Local bond vol is already completely fulfilling the fiscal dominance thesis. All EM bonds, not just the best like Asia, which we showed in detail on a yield basis, not on a vol basis. In fact, if you do the efficient frontier, just based on backward-looking, squiggles, risk return, for a mid-vol, or let's call it a low-vol, mid-vol, 6.5 vol portfolio, you were supposed to have had 20% in fixed income of your fixed income in that. We've done papers on this showing how your Sharpe ratio improves and all that, and you can read all that stuff. But this is what our benchmark has done in the last 20 plus years, and this is what DM bonds have done. We tell you the index we use. You could use other indexes. You could use the AG or whatever. And of course, I showed you the vol adjusted conclusion. That's really it. Again, this is a long story. It's based on things that are not changing that much. What might be changing is more people are aware of it, given the concern they have on high debt levels and low yields on DM bonds. But I'll just go briefly now to go through our process, just to let you know how we do what we do. The first thing I'll say is a lot of institutions understood the thesis on EM bonds. Oh yeah, they have low debt and they pay you more, right? Or the yields are higher and the vol is lower. Whatever the argument is, they're kind of similar. And then implemented it in a very precise way. So we think blend is the right approach. In other words, if you like EM bonds, invest in EM bonds. Don't say you like EM bonds and the only thing you want to do is invest in Asian local currency, right? And this has happened. EM institutions have had not the best experiences with EM bonds, I think largely because of that. In fact, our seeder came to us over 10 years ago and wanted us to do local only. We told them no, they didn't want that. And thank goodness, because local has not been a great performer for the last 10 years. Asia has been for the last 6, but local has largely been a dog. We happen to like it now. But if you had implemented your approach entirely in local, your thesis would have been right and your implementation would have been wrong. Probably the biggest sin on a trading desk is being right and losing money. Similarly, Asian investors got excited about EM bonds and did it all through Asia. Most of what they did was correct, but they ended up with very high exposure to Chinese corporate bonds rated investment grade, particularly in the property sector. So number one is we think you're supposed to invest in everything in EM. How do we do it? I'll be very simple about it. Number one, find cheap bonds. How do you do that? You compare their fundamentals. This is how we measure their fundamentals to how much they yield. And you focus on these countries. This is an example of 10-year dollar-denominated bonds. These countries have 10-year dollar-denominated bonds whose yields are too high relative to their fundamentals consistently measured. We do it for 2s, 5s, 7s, 10s, 30s, and we do it for local using real yield. So step one, the core of our process only looks at cheap bonds And that's really the core of the process. We want to get paid too much for your fundamental risk. Now, there is non-systematic risk. We're somewhat known for being the only EM bond fund that had no Russia, Ukraine going into that invasion. We had no China going into the property collapse. That's why we have step two, which is essentially kicking things out. And we have three categories, they're written here, and we kick them out and we document once a month. That's really the process. Step one, find cheap things. Step two, kick them out and document. And we have risk limits, as you would guess. And with that, I'll turn it over, I think, to Bill.
Thanks, Eric. But before we wrap up and get to Q&A, I did want to just highlight the results of having this ability to find the best opportunities in EM, and also the result of applying Eric and team's disciplined investment process over the years. As one of the first truly blended EM debt strategies, we're fortunate to have a very long track record of over a decade to look at. And in fact, among EM bond ETFs, it has the longest track record. And on this slide, we show here that the fund has outperformed the broad category. So that's including mutual funds and ETFs that invest in EM bonds, with top quartile performance in most trailing periods and top decile performance year to date and in the past 10 years. In fact, actually in the top fourth percentile year to date. As Eric mentioned earlier, the asset class has outperformed the US Ag and global Ag over the past decade. But if we go to the next slide, we can see that EMBX has provided investors with significant alpha on top of that of about 150 to 250 basis points per annum in most periods, including 236 basis points year to date. The fund recently converted from a mutual fund to an ETF. The ticker is EMBX. The same strategy, same process since the fund's inception in 2012, but now with the benefits of the ETF structure, including liquidity, transparency, costs, and ease of access. And as of Friday, the EMBX provided a 30-day SEC yield of 6.4%, making it an attractive part of a broader fixed income portfolio. And with that, David, I will hand it back to you.
Bill, I know we had a couple questions. Feel free to ask while we answer the first couple. So I'll start with the first one. So Eric, I know EM bonds have been doing really well as a whole, but Eric, can you tell us some of the most compelling country-specific stories that you've seen in EM this year?
Yeah, what a great question. So I would say we did write our latest IMF takeaways. So every 6 months we go to the spring and fall IMF meetings. We meet with all the finance ministers and central bankers who are interested in meeting, and we do write about this stuff. So, but I would say one category of winners of compelling stories, the way the questioner asked, is in Latin America, given the U.S. administration's big focus on the region. We all know that national security considerations are more important in economic planning. In fact, nobody criticized China for overcapacity at the spring meeting simply because all the developed markets are now copying China. That whole thing has kind of gone away. And part of that is also a big focus. You could call it a renewed economic Monroe Doctrine. In the US, we've seen huge evidence of it. I'm going to mention a bunch of small countries. The first one you think I'm going to mention is Argentina, but there is a global surplus of opinions on Argentina. I'll touch on that briefly. But it's Bolivia, just had an election. We were able to meet both presidential candidates for an hour before the election, both of the market-friendly candidates. One of them won, arguably the better outcome for the market, although both outcomes would have been fine. It was very clear that there had been extensive, healthy cooperation with U.S. Treasury. In fact, when the election happened, right after the U.S. made available special energy resources for the political transition, because the government's doing good policy. They're reducing energy subsidies. That's a great example. Ecuador, where we've had exposure for a long time, is another example. Military base looks like it's now going to be reopened. So obvious strategic implications. There was a lot of U.S. security during the election. And the IMF program was increased. The U.S. is the biggest shareholder in the IMF. Argentina is a more obvious one. We did not own Argentina before the big blow up 2 months ago. It did show up as cheap, but step two kicked it out. And we didn't because they hadn't fully addressed their currency regime. They need to float the currency, but also was the most popular thing in the world. It sold off, and we bought it for one reason because it went down a lot, and because this policy support from the U.S. looked likely. So they now have a lot of flexibility and freedom to act. Whether they make the right decisions or not is a more complicated decision, and that's why we're only investing in dollar bonds. But what's going on in South America is one big thing. I'd say another big good story is EM's EM politics is a good story. Scheinbaum is incredibly popular and implementing extremely orthodox economic policy. Even in Brazil, which I've been covering for 30 years, Lula is plays games with the market because he respects it. He knows he has to. So the ongoing popularity of governments that are doing the right thing, I think, is another big theme. And let's see. Oh yeah. So that's maybe one or two sets of themes. Another one is a lot of countries replacing Russia as a major energy supplier for Europe, mostly in sub-Saharan Africa. Again, small stories, and I hope you get the sense that this is very diversified, right? These situations, and then yeah, I'd say those are the best. Those are some of the better themes that might not be known. And Europe winning from geopolitical uncertainty. Remember, the center of military gravity has moved to Poland, away from Germany, so away from a DM towards an EM, a perfect capture of example of how EM wins from a lot of these situations. And so Poland and Hungary, I would put in those categories. Oh, and then the biggest single best big story is South Africa. It's a big part of the benchmark. It was hated at the beginning of this year around elections. I was a formal sell-side economist on South Africa 30 years ago, so I'd signed my name in blood on the country. And we had a very strong view that this was an incredibly positive development. And they've done everything we thought they would. Maintained incredibly disciplined monetary policy. It's one of the most independent central banks in the world, and improved fiscal and structural policy. And it's been one of the big winners this year. And that's a really serious story, and it's re-rating. It's a re-rating story. They got upgraded by S&P on Friday. So I'd say those are some of the big themes or stories.
Okay, great. We got another question here. Can you please elaborate on step two of your process when you kick things out, and how do you protect against headline risk or shocks due to geopolitical uncertainty?
Yeah. So here, I'll just go to that slide just so you can see some of the details. But so step one is 100% quantitative, and step two is 100% subjective. We may put a lot of numbers into our thinking in step two, but they're not they don't spit out an answer for us. We have to choose what we're looking at. And you asked specifically about geopolitics. I guess I would say that a couple of us on the team grew up, so I in particular grew up covering EMEA, all the countries between Russia and South Africa. So, I'd write on Russia, Nigeria, South Africa, Egypt, Turkey. What you might notice about those countries is those are pretty much the only countries that generate geopolitical risk from a U.S. standpoint. And so I'd say that's one thing is we don't think that we are predicting geopolitical stress. We think we are doing country by country by country analysis. And yeah, some of them will point to geopolitical stress, but that's it. That's entirely how we kicked out Russia and Ukraine. And so we, like I said, we were the only EM bond fund that had no Russia or Ukraine. It showed up as cheap in step one. What did we do? We failed it. failed it because we thought there was sanctions risk. We failed on policy politics test. We failed it on technical because we thought it would get kicked out of indices and everyone was overweight. Why? Because it was cheap. We didn't disagree that it was cheap. And by the way, it wasn't as smooth as we're making it sound. Well, we owned better things, Georgia, Turkey, but I'm guaranteeing you, nobody called us before before it sold off. No one was calling us and saying, why, isn't it great that you don't own it, right? Everyone was saying, why the heck don't you own this? It's cheap. Everyone else does. And we kicked it out for policy politics due to sanctions risk, but also technical. It was a very, very popular position, and um, and and sanctions is existential risk. And when the events happened, folks would call and say, "Oh, you predicted the event," and I want to go out of my way to say that we're not in that business. We were not predicting a geopolitical event. We were speculating about it and thinking that it was possible, but you were getting 200 over treasuries and Russian dollar-denominated bonds after all the news was known. So I was getting a lot of calls from my competitors, and the number one obstacle to selling had nothing to do with being unable to process the information. It had to do with culture. People don't go zero weight things, right? Big index weights. We do, right? We can't do too much of it, right? We have to budget it. Max we can do is 15%. When we think you're going to lose all your money, or you're getting paid 200 over for something like sanctions risk, essentially losing all your money, that's the way we will make that decision. But it's subjective. It's in step 2. Here are the 3 tests, and we document every month. And we were documenting defensively for most of the time, not owning those. People only like it when it works out.
Great. Thank you, Eric. We had another question here around positioning. When you think about local versus hard, what is your current positioning looking like in the fund, and how has that changed this year?
Yeah, great question. So I'll answer it 2 ways. So we have liked local most of this year. And the max we're allowed in local is 60%. Typical, that's a very normal limit or constraint for a blend bond fund that does both. So, and we took it to the max, really in March of last year, around 60%, and held it through until about 6 weeks ago. And we've reduced, and we're now in the high 40s. And we'll probably reduce more going into year end for reasons we write about in our monthly, but our overweights were Brazil and South Africa. Brazil's overweight 35% this year. There's a lot of good news in the price. There's been a lot of hate for the dollar, so I would refer to our monthlies for our detailed, why we changed in the last couple of months. But it's largely due to the incredible rally of our overweights, and it's country by country. South Africa, we've maintained our overweight. So how local hard has evolved? Max around March, around IMF meetings, the max bearishness over this stuff over tariffs, and we have reduced it in the last 5 weeks, and will continue for very specific reasons. In Mexico, we're probably likely to reduce because it's done really well and beginning to hit targets. Similar maybe in South Africa, though we're reluctant. But so that's the answer, is around 60 in March, and kept it that way, and then to take it down to a little below 50 and might go a little lower. However, the composition can be important, and we've never made a decision on local hard in our lives. We don't think we've ever thought about the world that way. It's all a bunch of very, very specific decisions. So when we look at why we reduced local this year, it's not a top, meaning recently. It's Brazil hit some targets, right? South Africa maybe hitting some targets. Colombia maybe becoming a little of a fiscal problem. So reduce it for that, but not for some top-down theory. I hope that was responsive.
Yeah, for sure. Thank you, Eric. The story for EMB is very, very compelling against the developed markets. Can you share what would be the 1 or 2 global macro events that will cause a drop, or it will cause the story not to work versus developed markets.
Yeah, so what would make EM not work against DM is developed markets getting their fiscal and political acts together. What's the next question? That was kind of a joke, but no, that really is, right? I mean, that's the whole thesis had nothing. I didn't get into anything else, right? It was all how much debt you have and how you run the structure of your economy matters for asset prices. One thing that would be a collapse in commodity prices. That would probably however there are plenty of things you can do in EM in that scenario. Like I said, they're very high quality credit, generally speaking, in dollars. Large numbers of EMs, regardless of how they make their money, how their economies are tied, already have a literal pile of dollars that's more than the dollar debt they have. Malaysia would stand out, right? Even Brazil would stand out. Brazil is a net creditor. So if commodities collapse, that would be definitely adverse for Brazil, but that does not mean it's adverse for Brazil dollar denominated bonds. And that's another one of these great attractions of EM is, we don't have views on Brazil, right? We have a view on 2-year local bonds, 5-year, 7, 10. We have a view on the 2-year dollar bonds, 5, 7, 10, and that's it. And you can like one and not like the other. But yeah, that's how I would respond. So yeah, if you think the DMs are going to wake up and get their act together economically and politically, that's a problem for this view. I'd also note that you're not really getting paid much carry, but I'm sure people know that.
True. Yes, yield has been one of the biggest stories for EM bonds, but I don't think we have more questions. So Eric and Bill, thank you so much for joining, and thank you everybody for watching.